I never remember a time in my life where the disparity of returns and necessary earnings growth to justify multiples, that disparity between sectors was so
Billionaire
large.
investor Ray Dalio, one of the most influential voices in global finance, has issued a series of urgent warnings regarding the future of the economy, the ongoing AI race, and the growing debt crisis. His insights suggest that the world is entering a period of heightened financial uncertainty, one that demands attention. Today, the United States is facing a serious debt problem. Dalio likens it to plaque accumulating in an artery, gradually restricting the flow of capital and making the system increasingly fragile. The country is currently spending nearly $1 trillion annually on interest payments alone. Without intervention, Ray Dalio warns that this could lead to a debt spiral where new borrowing is required simply to service existing debt, ultimately resulting in economic instability. At the same time, the global AI race is intensifying. Dalio describes it as an economic battle that no nation can afford to lose. While American tech giants focus on high-performance AI models, China is taking a different approach where they are leveraging their industrial strength to produce low-cost AI chips. This strategy is already reshaping the industry. Chinese AI firm DeepSeek's recent breakthrough has caused significant disruption in the market, leading to a $600 billion decline in NVIDIA's market capitalization. Also, tech companies' valuations today are at extreme highs. AI stocks in particular have seen massive price surges, which are mainly driven by optimism over the technology's potential across many other sectors and industries. So with all of this going on in the world today, what does the future hold for investors and the global economy according to Ray Dalio? And what are some of the solutions and investment strategies that Ray Dalio suggests to navigate such uncertain economic conditions?
I think that like the tech war for the AI war, it easily is, I think it is actually, more important. It's a war that no country can lose because it's more important than profits. And it could be like electric vehicles or more in terms of Chinese electric vehicles and the like, you can produce them. So I don't think, and I think there's such expectations. I think we are going to see applications. Like, I think the Chinese are a bit behind in the chips, but they're ahead in the applications.
Ray Dalio warns that the AI war is a conflict that no country can afford to lose, because whoever controls AI controls the future, not just in business, but also in military strategy, economic influence, and global leadership. He believes that winning the technology war will determine the winner of any potential military conflict. In other words, this isn't just about making better chatbots or automating industries, it's about dominance and power, not just profits. Ray Dalio sees a clear pattern in how China is playing the AI game. Instead of competing with the US in cutting-edge AI chips, China is focusing on manufacturing very inexpensive chips that can be mass-produced and embedded into everything, from consumer products to robotics. This mirrors China's strategy in the electric vehicle industry, where it prioritized scale and affordability over high-end innovation. China is also applying the same strategy to AI, making sure that its AI technology follows the same approach. When it comes to fixing the US deficit, Ray Dalio argues that tariffs are one of the tools on the table, but they come with consequences. The government needs to raise revenue, and tariffs are a way to do that. However, people don't usually think of tariffs as a form of taxation, but in reality, they function just like one. Even though they don't appear as a direct tax on individuals, they raise the cost of goods and they act as a form of inflation. Tariffs aren't just about economics, they're a geopolitical tool as well. Ray Dalio highlights that tariffs often escalate into full-blown trade wars, influencing diplomatic relationships and global supply chains. Apple shares, for example, have been negatively impacted due to the recent tariffs on China, since these tariffs now affect the company's ability to manufacture its products there. Some of the possible workarounds for this problem for Apple or even similar companies is that it could have its manufacturing suppliers increase production in other countries like India, for example, and ship to the US. Ray Dalio warned that the long-term impact of these tariffs is difficult to control, making them a high-risk strategy in an already uncertain economic environment. So, while such tariffs might provide a short-term boost in government revenue, they also come with the risk of higher inflation, economic retaliation, and unintended disruptions to local and global trade.
But there's also, revenue also, tariffs produce revenue. But yeah, people think on the tariffs, People don't think of taxes as inflation, but taxes are inflation because it costs you more. So the real question, as you play with the numbers, is it's very, very difficult to know and be precise about how much is going to come from productivity and profit increases from the efficiencies gained by AI and new technologies, how much is going to come from this and that. We don't honestly know.
When it comes to how to navigate the current economic environment that investors are facing today, Dalio emphasizes that diversification is key to managing risk and reducing exposure to unpredictable market swings. He avoids being overextended on an alpha, meaning he doesn't bet too heavily on any single investment. Instead, he spreads his risk across multiple asset classes, ensuring that his portfolio isn't overly vulnerable to one sector's downturn. Also, Ray Dalio emphasizes the importance of alternative money such as gold and Bitcoin, saying that he holds both of them. He suggests that a well-balanced portfolio should have 10% to 15% in gold, as it historically holds up during financial crises. And when it comes to Bitcoin, he said he doesn't hold as much Bitcoin as gold, but he acknowledges its role as an alternative form of money where it is similar to gold since it isn't tied to a government or a central bank, making it attractive during times of high inflation or currency devaluation. Ray Dalio also warns that pricing is everything. He argues that a great company with an overinflated stock price is a far worse investment than an average company with a cheap valuation. That's why he advises investors to consider the value a company provides to its consumers and how cheap it is relative to its potential, rather than simply investing in well-known companies with very high prices. Dalio suggests that pricing is a critical factor and that many investors make the mistake of wanting to buy good things from great companies without considering the price. He also drew a parallel between what's happening today in AI and tech companies and what happened during the dot-com bubble in the late 1990s to highlight and bring awareness of the current market valuations, which are currently at historic highs.
I never remember a time in my life where the disparity of returns and necessary earnings growth to justify multiples, that disparity between sectors was so large. The United States pricing and all of that has become very, very large. And within the United States, those tech companies and so on have become very, very large. And I'm not saying they're too high, but there are, they may be. So when I'm looking at the pricing disparity, I am concerned. I think there's a lot of enthusiasm by the stocks that we all know, the Magnificent Seven and beyond that. I think the biggest tech impact, of AI, will be in the users, not necessarily the producers, to be able to change their cost structures, to be able to have the benefits of the efficiencies and so on. And I don't think they've received anywhere near the adequate amount of attention. So I would rather be in those types of sectors if I'm playing that part. But I'm also, I believe a lot in diversification. I also think that people don't have typically adequate amount of gold in their portfolio. In other words, gold, if you didn't have a view of the market, like the gold market, it's a very effective diversifier under the other portfolio, because when bad times come, gold is a very effective diversifier. So I think that having something in the vicinity of 10% or maybe a little more, 10 to 15% in the portfolio is worth giving some thought to. And when I say gold, some people might say digital currency and so on. I own some digital currency. I own some Bitcoin too. But in other words, debt is money and money is debt. And we have a problem. We have a supply-demand problem with it. And so a good diversifier for a typical portfolio is that. We have a lot of people, a lot of the market is leveraged long, like long. Everybody wants everything to go up in there, and then they get excited and then they get leveraged long. And that creates a position that could be difficult.
So that was it for this video. If you enjoyed this one, make sure to leave a thumbs up and to click the subscribe button below. And with that being said, see you in the next one.